This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The archives.
Episode 40. If shares had a use by date.
Today on the Debunking Economics Podcast, imagine if shares had a use by date. If you pass the shares issued by a company onto a secondary market, the clock starts ticking. What would that do to the valuation of shares, and why do we need to worry about it? Well, if you read Steve Keen's book, Debunking Economics, he talks about the idea of Jubilee shares as a means of relating share price to the actual underlying value of the company that you've invested in. Steve is here to talk more about this. So first of all, Steve, don't shares reflect the value of a company? I always like to start with a joke.
I could leave it at that. They reflect the valuation the public is currently placing on the direction in which the share is going to go over time. And this can lead to some shares being massively overvalued and others being massively undervalued compared to what they're actually going to return over that period of time. Keynes made the wonderful comment about the market can remain irrational longer than you can remain solvent, which of course is the lament of a short seller we had talked about in the previous podcast. But it's the extent to which shares deviate from whatever you might actually call fundamental value, which really are in that sense, it's what you expect in terms of a return over time from that share, discounted by a rate of interest. And massive deviations from that level of valuation. And the main worry that I have about shares is not so much how will they be overvalued or undervalued. The price that they have does bugger all for the company that is actually standing behind the share, because the vast majority of trades are not buying new shares off companies and therefore through the price paid giving that company investment funds. They're going between different people who are gambling over which direction the share price is going to go in, and doing it on a levered basis as well.
Well, the company won at the beginning, of course, because it got the money right at the beginning when it first sold those shares. So does it matter to the company what happens next? It's a bit like looking at how much money did Rembrandt make from all the resale of his paintings. So long as he got a good fair price on his on it, which he probably didn't on his first sale.
Well, we're talking about Van Gogh here as well, of course, who died completely neglected, and now Van Goghs are worth a fortune.
Yeah.
So it really is a case of, if you actually want the share market, just like if you want the art market to actually generate art, then you better finance artists rather than speculators on art, first and foremost. And the same thing applies with the share market. If you want the share market to actually be a place that raises equity capital, which is the background portrayal we have, then you have to set it up in such a way that it actually generates most of that turnover for primary share issues rather than for people gambling over the share price. Still, I've got to chuck a little reference in here. I've got a wonderful family and a very lovable and earnest brother-in-law who was at one stage explaining to me when he was establishing his self-managed superannuation fund that they were going to put a lot of their money into Cochlear shares, Cochlear being an Australian company that invented bionic ears, because they really appreciate the technology. And I didn't have the heart to tell him the shares he were buying were going to provide zero revenue to Cochlear. That's what he actually thought he was doing by buying the shares.
Yeah.
Now I say, that's a good idea. Let's make that the main thing that people do when they go to the share market.
Right. So invest in the company rather than having a secondary market. Let's look at that in a second, though. But I just want to examine whether we have a significant problem, because obviously we've got the issue that once the share's been sold, it doesn't, as you say, the money doesn't go to the company. It becomes rife for speculation. That can create bubbles, and that's a concern. But that gets knocked down to size, doesn't it? We have crashes. The stock market is up and down. If you look at the price to earnings ratio, and there's other metrics, but the PE ratio, in other words, how much you pay for a share and how it is related to how much the company earns. That's one metric that's used to try and keep investments in check and to make sure we're not overpaying. Over the best part of 100 years, let's look at the S&P 500. The price to earnings ratio has been below 20 for the best part of that 100 years. Now, there's been crazy peaks like the dot-com boom, and in 2009, I think because earnings dropped and people assumed that they would come back, so the price to earnings ratio shot up. It's not like we're seeing a continued rise in the price to earnings ratio. So that surely shows that there is some sort of linkage between the price that's being paid for shares and the value of the company that they're linked to.
Yeah, but that is massively out of whack over time. And like at the moment, if you look at the average valuation that shares have using probably the most accurate measure of that, which is Shiller's price to earnings ratio, where he takes the current price level and divides that into the earnings. Divides that by the earnings over the previous 10 years, which gives you a stabilizing factor on the actual earnings. That index has been, I think, of the average value of about 14 to 18 over the last century. It peaked at 40 plus in the stock market bubble in 2000. It's currently running at about 30. So in that sense, you can say that over the long term, by compared to long-term returns, share prices are currently twice what they should be. And yet what's actually happening is that becomes the mechanism by which we borrow money into existence, one of the mechanisms we do, which actually generates a level of economic activity. So we're basing our economic activity on the continuation of the unsustainable. And this is the sort of insane thing that I would like to bring an end to.
Well, and you talk in your book about the greater fool principle. In other words, we all rush to buy shares that, perhaps because they're hot right now, we just follow the crowd. Does that apply to everybody? I'm imagining that would happen for the mum and dad investor, but the seasoned investor, I'm wondering, if you've lost a lot because you made a bad call, you're not going to keep on doing that. So can you keep being a greater fool?
Oh, yes. I mean, that's one of the jobs of an institutional investor, to continue being a greater fool. And this is, again, one of the reasons why the usual mainstream economics is such nonsense about the actual behavior of the stock market. The best arguments about this were actually made in a very brief sense by Keynes, both in the General Theory in Chapter 12 and also in some of his 1937 papers. And he explained that institutional investors are forced by the conventions of the finance sector to go with the crowd, to do what the crowd believes. He said, if you don't buy the popular share at the time, then you are derided. You're likely to lose your job at the next 3-month review. So the pressures of the stock market actually make you buy and follow the herd. So rather than professional investors actually looking for value and giving you a valuation return, they actually amplify this underlying instability in the market. And the same arguments were made in less eloquent way, but more technically by recently deceased a maverick finance economist called Bob Hagen. And Hagen developed what he called the inefficient markets hypothesis. And a major part of his argument was that the conventions of professional investors, superannuation funds, pension funds, insurance companies, et cetera, banks themselves, with their quarterly reporting pressure, they push people into having to have a portfolio that's not too different to the index. So whatever the index is, and the index itself reflects the weighting of different shares in the marketplace, that's what they're forced to buy. And he said that therefore means that there's a profit opportunity for people who are not institutional investors to do the opposite. And the basic thing he says is, don't buy shares with a high book to market, buy shares with a low book to market valuation. So if you find the high book to market valuation, you find the book value of a share in terms of what the assets of the company are worth, to say, come out to $10, and the valuation of the share, you could sell all the stuff. You could sell the current capital of the firm for $10 per share, and you find it's got a valuation on the stock market of $5 per share. So that's the sort of share you buy. But if you find you've sold everything it's got now for 10, and the actual share market rises to 30 or 40, don't touch it. But the ones that have got the high market, the low book to market ratio, the high market to book, it's one of these things I keep on stuffing up the actual terms myself with, I'm afraid to say. But if the market puts a much higher valuation on a company than you could actually sell its assets for right now, that is most likely a share which is going to be identified as a growth stock. And that's what the market pours into those stocks, because those are the ones that are currently rising. They've risen from what they've obviously started from a zero at some stage, effectively book value and market value. Now they've got a market value far higher, and the conventional wisdom extrapolates that into the future. Now, Hagen's point was that these firms are going to fail to have reached the expectations in the vast majority of cases. So the returns they're going to get are not the ones people are extrapolating into the market. market, and therefore if you're a standard investor, if you're investing your own funds, you can profit by not buying those shares, by buying the ones they neglect, and you'll find shares which have got a very high book to market ratio. He said buy those instead, and that's fundamentally the technique that Warren Buffett has been using very successfully for the last half century.
Which anyone could do, of course. I mean, it all gets down to like anything, doesn't it? You make money from the more research you do, so the more clued up you are, rather than following the herd, then the better you're going to do. I mean, that makes sense. That's just an argument for why you should research where you're putting your money, irrespective of where you're putting it. But let's look at this. Yeah. Let's look at this concern that prices don't reflect value, and you're saying that part of that is because people are borrowing to invest, and that's adding to the debt burden, but not in a particularly productive way. And that obviously applies equally to other assets, particularly houses, which we've spoken about, and we know that has inflated house prices. So presumably it is inflating share prices in the same way. Doesn't that mean then, if you did anything to stop that, if you said, well, okay, we don't like people borrowing to invest, if you did that to housing, we know house prices would come crashing down. So if you did it to the stock market, even for that initial sale, if I'm a company that's trying to raise money on the share market, and people can't borrow money to make that investment, aren't I going to find it a lot harder to raise the capital to get my business off the ground?
This is one of the curlies that made me talk about Jubilee shares in the way that I have, rather than just saying let's ban borrowing money to buy shares. Because again, like when I proposed the idea of a modern debt Jubilee, of a debt Jubilee in general, writing off debt, one of the first responses I got was, what about moral hazard? What that penalises people who themselves didn't gamble. And I said, you're dead right. We have to find a mechanism that means that people who didn't speculate also benefit from this. So that's why I said a modern debt Jubilee, use the government's capacity to create money, to inject money per capita into people's accounts, regardless whether you borrowed money or not. So in that sense, savers get a cash injection, whereas debtors get a debt reduction. There's no bias in favour of debtors over savers in that situation. So you did a similar thing for shares. And the thing is, I don't mind if people borrow money to buy shares in a company because they believe the company is going to be a success and the funds actually go to the company. So the idea of a Jubilee share is a share which, when you buy it in an initial public offering or a rights offer or at any stage that a company actually issues the shares, then it behaves exactly like a current share does right now. You get the dividend payments, you get the right to vote, and the share lasts forever. But the idea is after a number of sales of the share, then it becomes a Jubilee share. And when it becomes a Jubilee share, it's got 50 years before it terminates. Right. So it can be this is a modification of an idea from my system dynamics friend in Norway, Trond Andresen, which he talked about what he called voting bonds. So the idea is to have shares, you buy a share in an initial public offering or a rights offer, then that is actually money that goes to the company. You can do whatever you like. You can borrow money to buy it. You can buy the share, can hang on forever. You can sell it. But once it's been sold a set number of times, then after, let's say after a dozen sales, which is enough time for price discovery, then bang, it's a Jubilee share. And from that point on, it's only going to give you its terminal value after 50 years is zero. And the idea is to remove the belief that the share price is going to reach infinity, which is the current factor that drags people in to pay ridiculous prices on the secondary market.
Right, so that share would then, because that share obviously is going to decline over that 50, it would be worthless the day before it expires. So the only reason you'd be buying that share from anybody on the secondary market is presumably because you're going to get very high dividends. But I mean, that share price is going to gradually slide. So that would have to be differentially priced to those shares that have not been sold.
Yeah, you'd have a sense in the market where initial public offerings would be something which would be sought after because they're the only ones which would have that. If you bought the share and hung on it forever, they're the only one with the potential for infinite price appreciation over time. So I'm happy to find a way to encourage people to provide capital for new ventures. What the share market would do. Because at the moment, when you look at the aggregate level of share creation versus share cancellation, frankly, the stock market is now a place where equity capital is destroyed rather than created, because most of the firms, particularly in the finance sector, what they're doing with the money they get from the public is buying their own shares and cancelling them. There's probably a net, I haven't actually taken a look at the figures for some time, but I would not be amazed to see at the moment we have net negative equity creation by the share market. Now that's not a healthy system.
Right. But is anybody going to buy these shares? I mean, beyond, so you're saying you'd allow it to change hands a few times, as you say, for price discovery, and also you need to allow for the fact that, might be someone dies, they want to pass it on to a family member and all that sort of stuff. But, but it can change hands a few times. After that, why would anyone be buying it? So you can say it's 50 years, you might as well say it's 20 years or 100 years, and no one's going to be interested in buying it, are they?
Well, it's partly, if you make it, say, 50 years, that's like an annuity. If you actually imagine somebody saying they want to buy shares as an investment for a cash stream, then you want to buy, the blue chip company and expect a dividend return from the blue chip over time. And this would be partly a way of meaning that you would buy, rather than buying bonds, which would give a lower yield, you could buy shares to get a higher yield, but that just like a bond's going to terminate in life after a set number of years, that would happen to the shares as well. And it's nothing unusual. By far the biggest market in terms of financial speculation on the planet is the bond market, not the share market.
Yeah.
The share market's the exception, not the rule. It gets all the attention, but it's not the biggest one by far. But I'm saying, to some extent, the fact that bonds terminate, which people have been coping with for 500 years now, is something we could actually extend to the stock market as well, and just retain this idea of infinitely lived shares to people who buy a share in an IPO and don't sell it. And then that way, you're saying, if you actually write about Tesla, for example, then that initial purchase is going to be extremely beneficial to you over time. But if you're also right about Tesla and it becomes a long-term cash cow, then you can also buy Jubilee shares in it and get a reasonable dividend return over time as well. You're still gambling on that return actually occurring.
Right.
But you're not, the greater fool idea that's going to be worth an infinite price, people are going to say, I'll pull my leg, it's going to expire in 49 years.
Right. But the difference is, with a bond, you're getting money back at the end. There's a terminal value on that bond. So you're getting the dividend plus you're getting money back.
That's also possible with the share. The terminal value could be the value it was purchased for in the first instance. So you provide. This is a bit, in mathematical terms, this is what's called an ordinary differential equation and a partial differential equation. A partial differential equation has boundary conditions, an initial value and a final value, normally. Bonds have got that. Shares do not. Now, partly the volatility of shares comes out of the fact it's like a whip. You're holding one end to the other area is loose and potentially infinitely long. You can whip that up and down, whip that down. Any valuation is possible. With a bond, because it has a terminal value as well as an initial value, you simply can't get that level of overvaluation. So the idea is to try to restrict the range the share market would move through by removing that potential for effectively infinite overvaluation. So a terminal value equivalent to its initial value, you get your money back from the company after the 50 years, after it becomes a Jubilee share, that removes that potential for the massive overvaluation we see in the stock market now, which themselves, of course, feed back into the real economy, causing a further overvaluation and speculative bubbles. Capitalism is unstable enough without the stock market adding to it, in other words.
Right. But, Bon, you mentioned bonds because it's an interesting parallel, isn't it? Because, in effect, we're talking about, in effect, turning a share into a bond is the easiest way to look at this. Bonds have a terminal fixed terminal price. They've got a yield which is set over the period of the bond, but of course they get bought and sold, and the price goes up and down, through speculation. Isn't that the same problem?
Yeah, but bonds never get as overvalued as shares do. Yeah. And there's massive amounts of trading in them, potentially because people doing this stuff are professional traders and they're aware of the dangers of shares. Bonds are slightly safer on that front. But the idea here would be that, like, a bond gives you a first claim on a company, a share does not. You're a residual claim holder rather than a first claim holder. But the fundamental idea of the share should have a terminal value and a terminal span, I think is quite a simple and sensible change. You want to, with the reason that it doesn't actually, like with the bond, you're getting a stated valuation on the bond. You're getting a 3% yield on a price of $1,000, that sort of thing. With you bought a share, you're getting no promise about the dividend return. So that is the gamble you're taking, and therefore you could expect a higher return on shares than you get on bonds. But the reason we get the greater fool valuations of this argument, it's going to go to infinity in the future, and all people are buying and selling, and it's a huge churn. I want to get rid of that churn. You want a level of churn that gives you the potential for price discovery, and you want also, and this is a very important point that I'm taking largely from Bill Janeway, who is one of the sponsors of and is a very successful venture capitalist who actually has a PhD in economics from Cambridge University under Nicky Kaldor. So he knows his non-orthodox economics. And Bill argues that the potential for a massive gain is what encourages people to be entrepreneurs in the first place. And he said to have innovation, you need to have people who can afford to waste money. Now, he said two groups can afford to waste money. This is when the government can waste it, because it has the capacity to create money anyway. That's Mariana Mazzucato's case about the entrepreneurial state. But venture capitalists can as well. They can waste money on 5 ventures because the 6th they expect to make a fortune. Now, you've got to have it possible to make a fortune, so that potential for the share to rise dramatically in price has to be there. But you want that for people to take out IPOs. You don't want it for people who are gambling on the secondary market.
Right. Good point. So it is quite a big shift, though, isn't it, in the way share markets operate? I mean, is there a way that something like this could be introduced in part so we can at least see the impact it has? Or is it one of those grand ideas that unless it's introduced everywhere for everyone, it's not going to work at all?
I think it's the sort of thing you could trial. You could actually imagine a company issuing shares which are described as Jubilee shares and see how it goes. The trouble is that, again, because there are other shares into which you can make a fortune, the odds are no, you wouldn't be taken up. I think the only thing that can happen is after a stock market crash. And that's one reason I proposed this stuff back in the 2000s, because it made sense to say, well, when the detritus is everywhere and everybody's blown their money, and you think, oh, God, that was a stupid idea to get involved in the stock market, then at that particular point, you might be able to say, well, we're now going to, in this particular country, we're going to redefine shares as Jubilee shares and see what happens. Because the thing you do want the stock market to do, the reason we actually tolerate the bloody place and talk about it so much as well, is we believe it's part of what's generating the capital, the investment capital that will enable new technologies and new industries to be created. Now, if it's not actually doing that, why do we pay it so much bloody attention? It's because of the greater fool effect. So I want to get rid of the greater fool effect and encourage it to do what it's supposed to do. But of course, I'm quite happy to admit the odds of that are fairly slim, unless we find ourselves in a period of long run stagnation and low price rise for shares in the first instance. Now, the odds are, given the valuation we're currently seeing on the Schiller Price Index and the extent to which shares have been driven up in price by the machinations of central banks with quantitative easing, maybe that day is getting close.
All right, well, we've got the answer when it does. Good to talk again, Steve. We'll catch you again very soon.
Okay, mate. Bye.
Interesting thought, isn't it? Now, look, next time, has the basics of economics missed out a vital function? Energy. Steve has mentioned this a few times in recent podcasts, and we'll explore that idea a bit more. I'm Phil Dobbie. I'll see you next time on the Debunking Economics podcast. Thanks for listening.